Wall Street's AI trade is about to face a double test, and this time, a simple earnings beat may not be enough. Microsoft and Meta report on July 29th, only hours after the Federal Reserve delivers its policy decision. One test asks whether massive AI investment is producing enough revenue, margins, and cash flow. The other asks how much investors should pay for those future profits when money is still expensive. The pressure is already visible. The Nasdaq lost 2% last week as investors questioned whether ever larger AI budgets are becoming harder to justify, and Alphabet's higher spending plans helped turn that concern into a market-wide debate. Even an upbeat forecast was not enough to protect Intel, whose shares fell sharply on Friday. The reaction says the market is no longer rewarding spending simply because the word AI is attached to it. Microsoft enters this week with real operating strength, not just a promise. In its previous quarter, Microsoft Cloud revenue grew 29%. Azure and other cloud services grew 40%. And the company said its AI business had passed a $37 billion annual revenue run rate. That gives Microsoft a strong starting point. But investors will now ask whether growth can remain fast enough to support the infrastructure bill and protect margins at the same time. Meta faces a similar test from a different business model. First quarter revenue rose 33% and operating margin held at 41%. But capital expenditures reached $19.84 billion, while free cash flow was $12.39 billion. Meta also raised its full-year 2026 capital spending outlook to between $125 and $145 billion. Strong advertising growth can fund that build-out, but the burden of proof rises every time the spending plan expands. Then comes the second half of the test, the discount rate. The 10-year Treasury yield closed Friday at 4.69%, and the Fed meets as inflation risks remain elevated and markets debate whether policy could become even tighter. Higher yields do not erase Microsoft's cloud growth or Meta's advertising engine. They simply reduce how much investors are willing to pay today for profits expected years from now. Confirmation will require more than headline beats. A bullish result would combine durable AI-linked revenue growth, controlled spending, resilient margins, and a Fed message that does not push long-term yields higher. The bearish confirmation would be rising capital intensity without proportional cash flow improvement, followed by a more hawkish rate path or another move higher in yields. If one side improves while the other deteriorates, the market may stay volatile instead of producing a clean trend. The key watch point is not whether Microsoft or Meta says AI demand is strong, because everyone already expects that. Watch whether the next dollar of AI spending is producing more revenue and cash flow than the last one, and whether the bond market allows investors to value that growth generously. The calm verdict is that the AI trade is not broken, but it has almost no room left for vague promises. Price is the surface. The real message will come from cash conversion, capital intensity, and the cost of money.